Okay, so we're recording. And all right. So what I've given you is a copy of what's on the overhead. So James, yeah, Zach's much better at it. He does have more practice, yes. All right, so the next section in the MICASA simulation is we're going to create a budget for MICASA. So remember that this is a brand new company, and the company um, wants a budget so that it can measure its performance to what they were expecting would happen. There's all kinds of information in this section about how you come up with the cash budget and the income statement. There's also an example of a budgeted financial statements, the budgeted financial statements in Excel format for you to look at. And there's all kinds of information in the case about how to come up with the numbers. So the most difficult part of getting this budget completed is the balance sheet. And you need to leave the balance sheet until you get the cash flow and the income statement done, and then you do the balance sheet. So the income statement and the cash flow is really prepared at exactly the same time because the information you're given typically is for those two items. Now, with the balance sheet for this specific company, there was numbers at the beginning, so this is not a budget for a brand new company. It's this company already had balances in the asset and liability accounts, so you can see that in the T account. So that's what those opening numbers are. They're opening balances in those particular accounts. Now, what we have to do to get the ending balances, because remember we're projecting, that's what a budget does. We're projecting what the financial position will be at a specific point in time, and this would be at the end of March. So we need to take the information from the income statement and the statement of, or the cash flow to come up with new balance sheet numbers. All right, so I'm just going to go down the income statement numbers, and I'm going to plug the information in the T account, the balance sheet accounts, that it's going to change. So when you think about sales, this first number right here, when you think about the sales number, what balance sheet account is going to change, assuming all of the accounts are on credit? Accounts receivable, that's right. So we're going to put that $1,300,000 in the accounts receivable number. And then we're going to keep going down the list. So this beginning inventory, you're going to ignore it because we already have that number in the inventory account. Purchases. When you think about purchases, we're going to think about the accounts. When you purchase anything, we're going to assume that it's all on credit. So we're purchasing inventory. So inventory is going to go up by $750,000. But so does our accounts payable. So that's the only number that usually changes two accounts on this balance sheet. Then we've got the ending inventory number. We're going to calculate that in the inventory account, so we ignore that guy. But we do have to do something with the $780,000. That's cost of goods sold. So the cost of goods sold affects inventory. So we have to take that $780,000 out of the inventory account. All right, now we're going to go to the expenses. And with the expenses, we assume that the expenses were all purchased on credit. So salaries, we're going to take the 81,000 and we're going to put it in the accounts payable account. Same with advertising. We purchase it on credit and then we pay for it later. So 210,000. Shipping, again, we're going to assume that it's a purchase on credit. So that's going to go into accounts payable. Amortization. Amortization affects accumulated amortization on the balance sheet. But when you look for accumulated amortization, there isn't one. But you'll see the property and plant and equipment account is net. Whenever you see that net word, it means that the cost of the property, plant, and equipment and the accumulated depreciation have been added into one account. So that $42,000 of amortization comes out of the property, plant, and equipment account. And then we have the cost of property, plant, and equipment and the related accumulated amortization. That's what net means. The 39,000 other, we're just going to assume that it was all on account. We don't know what it is. So we got that one. And then interest expense. We're going to assume that it goes into interest payable or accounts payable first. I just took the interest payable or the interest expense and put it into the accounts payable account. Nothing. I didn't do anything with it because that's going to be the balance in this inventory account. Yeah. Other questions? Okay. The other item that goes on or affects the balance sheet is the net income, because net income affects retained earnings. So this $80,600 makes retained earnings go up. Okay, now we're going to look at the cash budget. Now, this cash budget basically calculates how much cash we're going to end up with in our bank account. So that's going to be the ending balance of the account. We can put the change in there if we want to, but we don't have to. And if you wanted to put the change in there, there's the number right there. It would be the cash available less the cash that was spent. All right, so we're going to start at the top. The cash at the beginning, we've already got 48,000, so that one's taken care of. Cash collections. We're going to assume that these are collections of accounts receivable. So we're going to take that number out of the accounts receivable account. I took the cash collections, and I took it out of the accounts receivable account. All right, remember that everything on this cash budget is a cash disbursement. So what we're doing here is we're paying this 760,500. We're paying for the inventory that we purchased. So the inventory that we purchased, if we look down in accounts payable, that's where we put it. So we're going to take that $760,500 out of accounts payable. The operating expenses, remember those are the payment of the expenses. So we're going to take the $395,000 out of accounts payable as well. Purchases of equipment, that affects property, plant, and equipment. So we're going to put the $86,200 in property, plant, and equipment. And the cash dividends affects retained earnings. So $45,000 comes out of retained earnings. So we get that one. Now in the financing, the company borrowed $80,000, which means notes payable would have went up. But in this cash flow, they also paid the debt off. So it's just an in and an out in that notes payable account. So really, you don't have to record them if you don't want to. And then we have this interest payment. The interest payment comes out of accounts payable because that's where we put the interest expense from the income statement. So what I want you to do now is go through, calculate the balances of all of these T accounts for me, and we'll see if we can get a balance sheet that balances. It doesn't usually work the first time, and you have to go through it again until it does. Say that again, Samantha? We did say that the statement of cash flows calculates how much should be in the cash account. We haven't done anything with it, correct, but we're going to take this final total that was calculated on the statement of cash flows. a number for accounts receivable? Inventory should be 30,000. And I know that because on our income statement they calculated the ending inventory. Property, plant, and equipment, 414,200. Accounts payable, anybody have it? Two people got it, probably right. Three people got it. Excellent. Notes payable is 0. Capital shares. Remember, capital shares and common stock means exactly the same thing. And retained earnings. And it balances? Wow. So you're going to take your assets, which are all on the top row, right? Add them together, and you get 727,100. And then you take your liabilities and equity. And you add them up, and it should be 727,100. And Jennifer says we're right, so we're good. So this is the most difficult part of your budgeted financial statements, is to get this balance sheet to work. So I find that T accounts are the best way to do it. You don't have to do the T accounts. There's other ways to get the numbers that will make more sense to you as you read the specific information in the case. But if your balance sheet doesn't balance by just using common sense and what's happening with your other information in the case, you got to resort to the T accounts to get things to balance. Questions? You did one in finance. Yes, and that's what we're doing here. Yeah, pro forma and budgeted mean exactly the same thing. Didn't create one, you're creating one now. Yeah, so now you are. It's going to be fun. You do it in managerial accounting too when we get there, but I think you guys have enough know-how to create them in Excel. I also have a sample that I'm going to give you as to what it should look like. But the best way to approach it is to do your income statement and your cash flow statement at exactly the same time. So when you read a piece of information and say, well, where does this go? And it's about sales, well, it goes on the income statement. But they also tell you whether or not they're collecting that money right now. So it also goes on your cash flow statement. The only difference that you'll really find, remember when we did the financial statement, the statement of cash flows? A budgeted cash flow looks very different than the financial statement. The format is very different. It's basically cash inflows minus cash outflows. And we don't bother with the operations, the investing, and the financing. We don't bother classifying them into the 3 categories. It's just what's coming in less what's going out. That's all your cash flow is. And that's for the cash budget. That's correct. And once we get over into the lab, I'll print you out the sample. I have it in D2L, but I'll print it out for you so you have a copy. I want, when you create your Excel document, um, I want you to make sure that you use functions and formulas so that if we decide to change a sales number, your whole budget is going to change, okay? And your balance sheet will still balance. So just make sure you follow that, and that's it. I know you'll have a lot of questions as you move through it, and that's what I'm here for. So we might as well go over to the lab now so you can get the sample and you can get started reading and analyzing and putting stuff into a spreadsheet.